US-China Trade War 2025. Is the global economy at risk? Hashtag trade war, hashtag US economy, hashtag stock market. The phrase trade war isn't new. We've heard it 100 times since 2018, when the US and China locked horns over tariffs, supply chains, and global influence. But here's the thing, the trade war isn't over. In fact, many experts argue we've just entered Trade Wars 2.0, and this time the battlefield looks a lot more complicated. It's no longer just about Washington versus Beijing. Today, the US is facing frictions on multiple fronts, with China, yes, but also with close North American allies like Canada and Mexico. Now, why should you care? Because these disputes don't just stay in government meeting rooms, they ripple into the stock market, into industries, into inflation, and ultimately into your wallet. If you've ever wondered why prices are rising, why certain stocks suddenly take a hit, or why companies are moving factories across borders, it's all connected to trade policy. And if you're an investor, this is exactly the type of insight that can help you position yourself before markets react. So let's unpack this together. First, let's deal with the obvious elephant in the room, China. For years, US-China relations have revolved around tariffs. Right now, the US has tariffs on over $360 billion worth of Chinese goods. These were initially designed to protect American industries like steel, aluminum, and manufacturing, but the effects have been mixed. On one hand, certain industries got a cushion against cheap Chinese imports. On the other, American consumers and businesses faced higher costs, and inflationary pressures grew. But here's where Trade Wars 2.0 gets interesting. This isn't just about tariffs anymore. The US is increasingly treating China as a strategic rival, not just a trading partner, which means restrictions are shifting toward technology, semiconductors, and critical supply chains. Washington has already blocked China's access to certain advanced chips, and there's pressure on US companies like Nvidia and AMD to limit their exports to China. Now, let me pause here for a second. If you're following along and finding these insights valuable, make sure you hit that subscribe button so you don't miss future updates like this. Trade policy changes fast, and staying ahead of it can be the difference between making the right investment and getting blindsided. Coming back to China, semiconductors are the new oil. Whoever controls chip production controls the backbone of AI, cloud computing, smartphones, and even military technology. That's why Taiwan's Semiconductor Manufacturing Company, TSMC, based just off China's coast, has become such a hot-button issue. The US wants to strengthen domestic production through the CHIPS Act, but that takes years. In the meantime, trade frictions keep escalating. If you're holding tech stocks, this is one area you cannot afford to ignore. But here's where many investors are missing the bigger picture. While everyone's eyes are glued to China, new tensions are quietly brewing right here at home, with Canada and Mexico. Yes, our closest neighbors, partners in the USMCA trade agreement, that's the updated version of NAFTA, are now clashing with Washington on multiple industries. For example, Canada and Mexico have both raised disputes over US subsidies for electric vehicles. Washington wants EVs made primarily in the US to get big tax breaks, but Ottawa and Mexico City argue that violates the spirit of free trade under USMCA. If this escalates, it could hit automakers like Ford, GM, and Tesla, along with battery suppliers across North America. Energy is another flashpoint. Mexico's government has been favoring its state-owned energy companies while sidelining U.S. firms in oil and renewables. That's prompted Washington to threaten trade penalties, which could shake up the entire North American energy market. Think about it. If disputes limit U.S. companies' access to Mexican oil and gas projects, you could see ripple effects in energy stocks, electricity prices, and even natural gas exports. And don't forget agriculture. Canada has pushed back hard on U.S. dairy access, and the U.S. has challenged Canada's rules as unfair. Now, to the average person, this might sound like a small spat over milk and cheese, but remember, agriculture is one of the most politically sensitive industries in trade. When disputes heat up here, it can spill over into broader economic relations. If you're invested in agribusiness stocks like Archer Daniels Midland or even food retailers who rely on stable cross-border trade, this is something to keep an eye on. Now here's a question you might be asking. Why would the US risk tension with its allies while already facing pressure with China? The answer comes down to domestic politics. Trade policy is one of those rare issues that can swing elections. Protecting American jobs is a powerful slogan, even if the economics behind tariffs are messy. Politicians know this, and with 2024 being such a politically charged year, trade disputes are almost guaranteed to intensify. This is why many analysts believe Trade Wars 2.0 is going to look very different from Round 1. It's not just one front with China, it's multiple mini-battles across industries with multiple partners all at once. That makes it much harder for investors because the risks are spread out and unpredictable. So let's break it down industry by industry. Technology and semiconductors are at the top of the list. Companies like Apple, Qualcomm, and Intel are heavily exposed to Chinese markets, and any restriction on exports or imports can hit them hard. Apple, for example, still relies on Chinese factories for iPhone assembly. If tariffs or restrictions tighten, that's a direct cost increase. Automotives and EVs come next. The US wants EVs built at home, while Canada and Mexico want fair access. Automakers with North American supply chains are right in the middle of this tug-of-war. Tesla, Ford, GM, and even European automakers with plants in Mexico are watching these disputes closely. Energy is another hot zone. U.S. oil and gas companies operating in Mexico could face barriers, while clean energy firms could lose out on subsidies if disputes escalate. And then there's agriculture. U.S. farmers depend on exports to both China and North America. Any retaliation could put pressure on grain, dairy, and meat exports, hitting companies like Tyson Foods, Bunge, and Cargill. If you've noticed the pattern here, it's that every sector connects back to trade, and trade connects back to inflation. Tariffs raise costs, supply chain disruptions raise costs, disputes raise costs, which means if Trade Wars 2.0 escalates, we could see another wave of inflationary pressure in the U.S. economy. And guess who responds to inflation? The Federal Reserve. So yes, trade wars can eventually feed right back into interest rate policy, stock valuations, and bond markets. This is why investors can't afford to ignore trade headlines. They're not just political theater, they're direct market signals. And hey, if you're still watching and haven't subscribed yet, seriously, what are you waiting for? Go ahead and hit that subscribe button right now. I share breakdowns like this regularly, helping you connect the dots between policy, markets, and investing opportunities. Now let's talk about what smart investors are doing in response. Some are diversifying away from companies overly reliant on Chinese manufacturing. Others are betting on US-based manufacturing plays that could benefit from reshoring. For example, companies involved in semiconductor fabrication in Arizona or Texas could see upside if the U.S. keeps pushing to localize chip production. In agriculture, watch for firms that have diversified supply chains, not just tied to one country. In autos, pay attention to which manufacturers adapt quickest to changing subsidy rules. And in energy, keep an eye on U.S. companies pivoting toward domestic projects instead of relying on Mexico. But the bigger takeaway is this. Trade Wars 2.0 is not a short-term headline. It's a structural shift in the way global commerce is going to work. We're moving from decades of globalization and free trade toward an era of strategic trade, selective alliances, and economic nationalism. That's a polite way of saying countries are putting their own interests first, even if it upsets their partners. For the U.S., this means prioritizing critical industries, chips, energy, EVs, agriculture, and being willing to clash even with allies to protect them. For investors, it means volatility, yes, but also opportunity, because every disruption creates winners and losers. So, as you're thinking about your portfolio, ask yourself which companies are prepared for supply chain shifts, which ones benefit if tariffs rise, and which ones are most at risk if disputes escalate. That's the lens you need to apply in Trade Wars 2.0. And let me leave you with this final thought. Global trade is no longer just about economics. It's about security, politics, and influence, which means markets will react not just to earnings reports, but to policy announcements, trade negotiations, and even diplomatic spats. If you can stay ahead of that, you'll be ahead of the average investor. That's why I'll keep tracking these updates for you. And if you haven't subscribed yet, don't miss out. Hit that subscribe button because Trade Wars 2.0 is just beginning, and you'll want every insight you can get.